Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're discussing a significant report from the Canada Mortgage and Housing Corporation, or CMHC, which states that Canada must double its housing construction to restore affordability by the year 2035.
That's right, Steve. The CMHC estimates that we need between 430,000 and 480,000 new homes annually over the next decade. It's a tall order, considering we're currently building at about half that pace.
Doubling the pace is indeed ambitious, but as Aladab Yorworth, CMHC's deputy chief economist, points out, it's achievable. However, it will require a significantly larger and modernized workforce, more private investment, and fewer regulatory hurdles. Innovation in construction technology and improvements in labor productivity are also key.
And it's not just about building more homes. The report highlights specific targets for both the ownership and rental markets, particularly in Canada's largest urban centers. Montreal, for example, faces the largest housing supply gap, with rising home ownership costs outpacing local income growth.
Absolutely, Janine. Toronto is another city highlighted in the report. It would need to increase its home building by 70% over the next decade to improve affordability, especially in the ownership market. Despite some progress in rental housing, there's still a shortage for prospective homeowners.
Vancouver also needs to step up its game, with an estimated 7,200 additional homes needed annually, a 29% increase above current trends. But there is some good news. The 33,000 housing starts recorded in 2023 indicate the region is moving in the right direction.
Calgary, on the other hand, has seen record home building levels for 3 years straight, but still needs to increase its output by 45% each year to meet affordability targets. Ottawa-Gatineau also faces a significant supply gap, despite recent increases in home building.
Interestingly, Edmonton is the only major city where projected housing supply is expected to be sufficient to maintain market affordability through 2035. However, CMHC warns that this doesn't mean all housing issues are resolved, as homelessness remains a challenge.
When we look at the provincial outlook, Ontario, Nova Scotia, and British Columbia are facing the most significant housing supply shortfalls. These provinces have seen some of the steepest increases in housing costs during and after the pandemic.
The long-term outlook from CMHC is based on a 10-year timeline, aiming to achieve affordability levels by 2035. This report focuses on market housing affordability for average income households, though it acknowledges the ongoing challenges faced by low-income households and those experiencing homelessness.
Ultimately, while CMHC believes Canada's home building sector has the capacity to exceed 400,000 new homes per year, reaching that potential will require systemic change across the industry. For those interested in more details, the full 2024 housing supply gaps estimate is available on the CMHC website. In recent news, Fitch Ratings has significantly downgraded its outlook for Canada's housing market. The agency attributes this to a weakening economic environment and expectations of a softer job market.
That's right, Steve. Fitch has adjusted its Canadian home price growth forecast to just 0 to 3% for 2025. This is quite a drop from their previous projection of 7 to 10%. The revised outlook highlights the challenges buyers are facing due to rising unemployment and caution among prospective buyers, compounding low affordability.
Indeed, Janine, the situation is further complicated by the fact that approximately 60% of Canadian mortgages will be renewing this year at higher interest rates. This is intensifying affordability concerns for both homeowners and those looking to enter the market. However, it's not all doom and gloom. Fitch doesn't expect a spike in mortgage delinquencies.
That's a bit of relief, Steve. The agency attributes this resilience to continued wage growth and the strong equity position of many Canadian mortgage holders. It's reassuring to know that despite the economic strain, many homeowners are still in a stable position due to these factors.
Canada's downgrade in home price growth was the most severe among the countries reviewed in Fitch's assessment. However, it's worth noting that Fitch also revised its home price forecast downward for the United States, Mexico, and the Netherlands. This reflects broader global economic headwinds that are impacting the housing market.
Yes, and globally, Fitch maintains an overall optimistic view, expecting broad home price growth and low arrears for the second half of 2025. They point out that housing supply constraints are driving price growth, and stable to declining mortgage rates are helping sustain demand, even with the slowing global economic growth.
Nevertheless, Fitch warns that downside risks persist. Higher tariffs and trade disruptions are weighing on the global outlook, and concerns about deteriorating macroeconomic conditions might keep potential homebuyers on the sidelines. This hesitation could further impact home prices.
It's a complex situation, Steve. While there are significant challenges, there are also elements of stability and resilience within the market. It's crucial for buyers and homeowners to stay informed and consider both the risks and opportunities in the current environment.
Young Canadians are finding themselves in a tough spot when it comes to keeping up with mortgage payments. According to a report by TransUnion, individuals aged 30 and under are defaulting on their mortgages at a rate 7 times higher than the general population. This is a significant concern, given the broader economic challenges many are facing.
That's quite alarming, Steve. It seems that younger homeowners are struggling more than others, with 29-year-olds and 30-year-olds showing the highest delinquency rates at around 1%. This is almost 10 times the national average of 0.12%. It's a clear indication of the financial pressures young Canadians are under.
Indeed, Janine. The data from TransUnion highlights that even super-prime mortgage holders, those with excellent credit ratings over 800, aren't immune to these challenges. The delinquency rates are even higher for those with lower credit scores or those accessing more expensive subprime mortgages.
It's a tough situation for sure. Many young people rushed into homeownership during the pandemic when interest rates were lower, and now they're facing the consequences as those rates have increased. They might not have built up enough savings to cushion unexpected costs, which is a big part of the problem.
Matt Fabian from TransUnion pointed out that a lot of young buyers are unprepared for the ongoing costs beyond just the mortgage itself. Many rely on parental support for their initial deposits, but that doesn't cover the continuous expenses of home ownership, especially with rising interest rates.
And as Bruce Sellery from Credit Canada noted, the unemployment rate is higher among younger individuals, which adds another layer of difficulty. Job losses can quickly lead to missed payments, and with condo values dropping, some young homeowners find themselves unable to sell to alleviate their financial burdens.
Exactly, Janine. Calgary area mortgage broker Joe Jacobs has observed that many young clients are extending their mortgage amortizations or consolidating debts to manage the increased financial strain. It's not just about the mortgage itself, it's the overall cost of living that's pushing them over the edge.
Bridget Van Wyk from Farber, a licensed insolvency trustee, encourages young people to seek professional advice before their situation worsens. It's crucial to explore options early, especially if they're turning to high-interest debt solutions like payday loans, which can exacerbate financial difficulties.
In the ever-evolving world of real estate, Ontario's housing and mortgage markets have been relatively quiet as summer begins. Economic uncertainty, fueled by ongoing trade tensions with the United States, continues to cast a shadow over the outlook for many potential buyers and borrowers across the province.
That's true, Steve. The trade war initiated by former U.S. President Donald Trump earlier this year has put thousands of Canadian jobs at risk, with Ontario's labor market feeling the pressure. But despite these challenges, the market hasn't crashed, and there are still opportunities to be found.
Absolutely, Janine. Dahlia Barsoom, founder of Streetwise Mortgages, points out that first-time buyers are cautiously stepping back into the market. Even with the home buying slowdown, There are ways for brokers to help existing homeowners, particularly through debt consolidation and improving their financial situations.
Yes. And Barsoom highlights that real estate investors in Ontario, who often own multiple properties, are feeling the pinch from rising variable rates. But this also presents opportunities for debt consolidation, which can ease cash flow pressures.
Another area of opportunity lies in modifying and expanding existing properties. Bill 23, the More Homes Built Faster Act, has introduced legislative changes to increase housing density by incentivizing the construction of additional dwelling units, making these options more affordable for homeowners.
That's right, Steve. With these changes, homeowners can now find contractors more easily and at more reasonable prices than a few years ago. This has made the expansion of living spaces a viable option for many.
On the investor side, the Canada Mortgage and Housing Corporation's MLI Select program remains popular. This program offers construction incentives based on climate, accessibility, and affordability goals, which can be more cost-effective for those looking to enhance properties or build new units.
Exactly, Steve. Whether converting a residential property to include more units or building from the ground up, investors are finding ways to utilize these incentives to improve affordability and energy efficiency.
While interest rates have fallen over the past year and home prices have dipped, affordability remains a significant hurdle for many prospective buyers. Some are now looking at properties with secondary units to rent out, which can help with mortgage qualification.
It's a creative solution, Steve. But as Barsoom mentioned, much of the market's future depends on progress in trade talks between Canada and the United States. Until there's some resolution, the market will likely remain subdued.
The uncertainty surrounding the economy is a big factor. Despite lower rates typically encouraging market movement, the ongoing trade tensions have kept many potential homebuyers cautious, worried about job security.
It's a challenging environment, but as always, there are opportunities for those who are informed and prepared to navigate the complexities of the current market.
Sellers in the Toronto area real estate market are facing a challenging summer as buyers take their time, leading to extended negotiations. The inventory of homes available has significantly increased since last year, yet sales remain historically low for a season that typically sees a surge in activity.
That's quite a change, Steve. In the condo segment, buyers are feeling more empowered due to the abundance of listings. Christopher Bibby, a broker with Re/Max Hallmark Bibby Group Realty, points out that some buyers are even becoming quite aggressive in their negotiation tactics.
Indeed, Janine. The average price for a condo apartment in central Toronto dropped 8% from last May, now standing at $758,214. This price decline is notable, especially when compared to the market frenzy of the past few years.
And it seems like the sales numbers reflect this slowdown too. Condo sales in central Toronto fell by 21%, while active listings increased by 14%. Some condo units are sitting so long without showings that owners are questioning if their listings are still active.
Christopher Bibby remarked that this is the most significant number of price reductions he's seen in his career, even when compared to the 2008 financial crisis. In some cases, condo owners who bought in 2019 might have to sell for less than their purchase price.
It's a tough market for sellers, but Pritesh Parekh from Century 21 Legacy Ltd mentions that despite the buyer's market, prices have held up relatively well given the supply levels. The average price of a detached house in the Greater Toronto Area fell by 5.4% from May 2024.
That's right, Janine. The Toronto Regional Real Estate Board reported that sales of all home types dropped 13.3%, while active listings surged by 41.5%. Darren King, an economist at National Bank of Canada, warns that the market conditions are the softest since the 2008 to 2009 period.
Yes, and while there was an 8.4% rise in sales on a seasonally adjusted basis from April to May, overall sales are still 29% below their peak in November. The labor market's deterioration in the Greater Toronto Area is a significant factor limiting recovery.
Pritesh Parekh also notes that many of the conditions buyers wished for during the market frenzy, more listings and less competition, are present, yet buyers remain hesitant. They are cautious about economic and political uncertainties and potential job losses.
Exactly, Steve. Some buyers are waiting for interest rates to fall further, while others are concerned about unemployment. Parekh shared an instance where a cautious buyer ended up losing their job, which illustrates the real risks buyers consider in today's market.
However, Parekh sees opportunities for those with stable employment to capitalize on the downturn, particularly if they plan to hold the property medium to long term. He doesn't foresee a quick market recovery, suggesting a slow transition to a different market environment.
Christopher Bibby has been handling offers for several listings, with only 2 resulting in signed deals. Some buyers are playing hardball, returning with lower offers after initial negotiations, a tactic that can backfire if it alienates sellers.
Bibby highlights that while some sellers still hope for 2021 prices due to unique features of their properties, the reality is that ambitious pricing can quickly be undercut by lower-priced listings in the same building, setting new benchmarks.
He anticipates a slowdown in new condo listings over the summer, but there is optimism for the fall market. If positive economic signals emerge, such as interest rate cuts or favorable trade talks, the market might stabilize as prices adjust and supply plateaus.
Despite the current challenges, Bibby believes this market lull reflects an unwinding of the unprecedented price increases seen during 2020 and 2021. It will take time to absorb the excess inventory, but the groundwork for this shift has been in place for a while. Let's dive into the latest inflation figures for May, which have been causing quite a stir in the economic community. The annual pace of inflation held steady at 1.7%, with cooling shelter costs contributing to this stability. This has been a focal point for many economists debating the possibility of interest rate cuts by the Bank of Canada.
Right, Steve. The data from Statistics Canada shows that shelter costs rose by 3% in May, a slowdown from April's 3.4%. Ontario has been a major contributor to this trend, with a jump in new housing supply and slowing population growth helping to stabilize rent hikes.
Despite the steady inflation, economists are cautious about the likelihood of rate cuts. The removal of the consumer carbon price has been driving down gasoline costs, but geopolitical tensions involving the United States, Iran, and Israel could potentially drive oil prices up, impacting consumer prices and inflation.
That's a valid concern, Steve. RBC's Assistant Chief Economist, Nathan Jansen, pointed out that any potential oil price shock would need to be prolonged to significantly affect transportation costs and retail prices. But for now, the cost of food saw a slight improvement, rising only 3.3% annually in May, down from April.
The situation is complex, Janine. The Bank of Canada held its policy rate steady at 2.75%, with core inflation metrics ticking down to 3% in May. BMO's chief economist, Doug Porter, notes that while inflation is moving in the right direction, it might not be enough for the bank to consider rate cuts just yet.
And as TD Bank's senior economist Andrew Hensich mentioned, the ongoing trade war poses additional risks. He suggests that while the soft economic backdrop could allow for future rate cuts, the decision hinges on how trade negotiations evolve.
Nathan Jansen, however, offers a different perspective. While acknowledging the economic weaknesses in trade-sensitive areas, he points out that consumer spending remains robust, and government spending is expected to increase, which might negate the need for further rate cuts.
It's certainly a balancing act, Steve. With so many variables at play, it's crucial for both buyers and homeowners to stay informed and watch how these developments unfold. The next few months will be telling, especially as we approach the Bank of Canada's next rate announcement in July.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.